Hello everyone, I'm the Dividend Portfolio and welcome to my channel. Today I'm very excited to share some of the research I've done on Lockheed Martin. Lockheed Martin is a very diversified and efficient company. I was very impressed with this company and I believe it could offer a very defensible dividend investment. So let's jump right into the core business. Now, Lockheed Martin operates in 4 distinct business segments. The first division is the Aeronauticals division. And so this division is involved in the research, development, manufacturing, support, and upgrading of advanced military aircrafts, including the F-16 and the F-35, as well as a number of unmanned air vehicles. Another one of their divisions is the Missile and Fire Control division. Now, the Missile and Fire Control division is involved in developing missile defense systems, air-to-ground precision strike weapons, various tactical missiles, fire control systems, and also ground vehicles. Their third business segment is the Rotary and Mission System. So this division is involved in providing and supporting various military and commercial helicopters, missile defense systems, radar systems, combat systems, surface ships, and training solutions. Finally, they also have a space segment, which is involved in satellites, transportation systems, and defense systems, which can provide customers with a number of intelligence data. So you can kind of get a gist here of the wide range of services and products the company provides. When we take a look at the financial history of the company, we can see that's performed very well over the last 5 years. The revenue here has had double-digit growth on a compounded basis. Their free cash flow almost was at 19% growth. Their net income was once again in the double-digit range. And what was very impressive is that their 5-year total debt actually decreased over this time period. So not only did they have massive growth in financial metrics, but they had, at the same time, they decreased their total debt. So I was actually very impressed with these financial metrics for this company over the last few years. Comparatively, when we look at LHX, which is L3 Harris, we can see that they had much higher growth in revenue, a little bit higher free cash flow growth, much higher net income growth, but this growth came with a significant increase in total debt. Conversely, RTX here, which is Raytheon Technologies, saw very little growth in revenue, significant decreases in free cash flow, and currently does not have a positive net income, and also has a significant increase in total debt. One of the really impressive components of Lockheed Martin is their competitive edge. So this is a very innovative company. They are awarded hundreds of new patents annually. They have an advanced development program, which is continually developing new cutting-edge technology to enable the company's next generation products. Furthermore, Lockheed Martin has been awarded the Collier Award 6 times, which is a very prestigious award administered by the U.S. National Aeronautics Association to those who have really made great achievements in aeronautics. So you can kind of get the picture that this is a very innovative company. And you can kind of see this here when you look at the company margins. Lockheed Martin currently boasts the highest profit margins out of these 3 companies, and their profit margins have slowly been increasing over the last 5 years. Conversely, L3 Harris and also Raytheon Technologies do have lower profit margins, and they've also been declining over the last few years. Another important measure of company efficiency is their return on equity and return on invested capital. And so we can see here for Lockheed Martin that they're doing a phenomenal job in terms of both of these returns. Here we can see that return on equity is nearly 150%, and return on invested capital is about 130%. And not only are these numbers impressive on their own, but compared to L3 Harris and Raytheon Technologies, Lockheed Martin is clearly blowing them away in terms of these returns. So in terms of efficiency, I would say that Lockheed Martin here is the very clear-cut winner. I would say that one of the areas that Lockheed Martin is a little weaker on is their estimated annual EPS growth. So here we can see that Lockheed Martin is expected to have about a 6% EPS growth through 2022. Where in comparison, L3 Harris is expected to have about double that, and Raytheon Technologies is expected to have by far the most EPS growth. I would say that with Lockheed Martin, because it's such a large company and has such a large market cap, that slower growth I think is to be expected. I'll also point out that all 4 of their divisions are expected to have this middle-digit level growth going forward. So in order to understand where this EPS growth is expected to come from over the next few years, let's take a look at the company's plans to promote growth. Now, first off, Lockheed Martin derives about 74% of their net sales from the United States government. Now, this leaves actually a large room for them to expand through the international markets. And so within the last 2 years, there's been a number of international sales growth, and this includes increased demand for the PAX-3 program in Japan, Taiwan, and the Republic of North Korea, THAAD missiles in the United Kingdom of Saudi Arabia, and also increased F-35 demand in Poland, Finland, Switzerland, and Spain. It's also important to point out that the F-35 production, which currently makes up nearly 28% of their total sales, is expected to continue for multiple years due to the U.S. government's objective of obtaining nearly 2,500 F-35 aircrafts. The United States government actually recently increased their orders for the F-35, and it's also important to point out that Lockheed Martin has nearly $150 billion in backlog for the company. In fact, some analysts have projected that the F-35 will be providing revenue for the company up into 2070. Lockheed Martin also expects mid-percent increases in sales of the Sikorsky helicopter program, integrated air and missile defense systems, additional training and logistics solution programs, and the development of their next-generation hypersonic capabilities. Finally, I think it's important to note that Lockheed Martin is acquiring Aerojet Rocketdyne for about $4.4 billion. Lockheed Martin predicts that there will be the ability to incorporate and improve Aerojet's Rocketdyne propulsion systems into Lockheed Martin's, and that there will be an opportunity to generate cost and revenue synergies. Now that we've taken a look at the financial history and also some of the growth initiatives for the company, let's take a look at the company's valuation. So here we can see that the forward P/E ratio is significantly below its 5-year average for Lockheed Martin. Interestingly, L3Harris is also in a similar position, although it has a slightly higher forward P/E ratio than Lockheed Martin. It is well below its 5-year average P/E ratio. Whereas Raytheon is approximately at a similar P/E ratio to its historic average. Interestingly, the price to free cash flow for Lockheed Martin is also below its 10-year median. In terms of PEG ratio, though, Lockheed Martin, once again, I think struggles with this component. They have a immediate forward PEG ratio of about 2, which is much higher than L3Harris's, a little over 1. And their 5-year PEG ratio is well over 3. So we can kind of see here that this goes with our earlier financial growth data that they're expected to have slower growth going forward. So I would look at this and I would say, based on the P ratios and forward price to free cash flow, that the company is undervalued, although I think it's fair to expect slower growth than some of these competitors kind of moving forward. One of my favorite things to do as a dividend investor is, of course, look at the dividend. And so I was generally overall impressed with their dividend performance. Here, Lockheed Martin offers a respectable 3.08% dividend yield, which is quite a bit higher than its 10-year median dividend yield. The company has had nearly 10% dividend growth rate and is expected to maintain a pretty solid 8% dividend growth over the next few years. The company is a dividend contender here with 18 years of dividend increases and boasts a very good credit rating of A- by the S&P. Furthermore, the dividend payout ratio is very attractive at below 40%. And their interest coverage ratio, the ability of their cash flows to cover interest, is phenomenal at almost 15 times. So from my perspective, this is a company with a solid starting dividend yield that also has a very well covered dividend by their low payout ratios and high interest coverage ratio, and also has the potential for some strong growth moving forward. Just to kind of go over some of the risks the company faces. One of the critical risks they face is their reliance on their primary customer, the United States government. There's currently been increasing competition, bid protests, and budget constraints which can actually affect Lockheed Martin's ability to balance the customer relations, i.e. the United States government, and their financial performance. Furthermore, the United States can impose sanctions on governments, which can limit Lockheed Martin's ability to do business in a particular country. One such example includes Turkey, which has US sanctions against it, and also Lockheed Martin is dependent on certain Turkish suppliers, which are single source suppliers for a number of F-35 components. So Lockheed Martin has until 2022 to find alternative suppliers for these F-35 components. Speaking of the F-35, it's also important to note that the F-35 does still have hundreds of different hardware and software deficiencies. Now, I think it's very important for the company to be able to step up and address these deficiencies, which with new technologies is to be expected. But the ability and the importance of the F-35 for the company's sales will be critical for Lockheed Martin to actually be able to address and improve these deficiencies. Furthermore, there have been a number of constraints brought on by the global healthcare crisis. Now, Lockheed Martin has performed quite well during this global crisis. It's important to keep in mind that their manufacturing has slowed for a number of their key products, which is reflected by the fact that they delivered 10% less of their F-35 aircrafts in 2020 compared to 2019. Furthermore, Lockheed Martin does also rely on a number of critical commodities and ingredients in their products, which may also experience shortages with additional or extended slowdowns from the healthcare crisis. So kind of here, I kind of have a graph depicting the summary about the company. In general, I was very impressed with Lockheed Martin. So over the last 5 years, they've had impressive revenue growth, very impressive free cash flow growth, strong net income, and they actually reduced the total debt for the company. The company, Lockheed Martin here, produces increasing and higher net profit margins than their competitors. And they also have amazing return on equity, return on assets, which I didn't show, and return on invested capital. Their EPS growth is slower than some of their companies, but considering the large size and so forth, I still think this is positive that they're showing growth. The company is arguably undervalued based on their PE ratio, price to free cash flow ratio, and also their dividend yield. Although their PEG ratio is probably the weakest part of their valuation, depicting their slower growth. Furthermore, as far as the dividend goes, they have a respectable dividend and have a great payout coverage ratio and is expecting solid dividend growth going forward. So all in all, I kind of view Lockheed Martin as a very diversified, efficient, and defensible company that I think could play a good role in a potential dividend investment portfolio. So kind of based on this analysis, I actually plan to develop a position in Lockheed Martin here going forward. So with that, these videos and this research does take quite a bit of time, this and the associated article on Seeking Alpha. So if I could get a subscription, a thumbs up, a like, a comment, I would certainly really appreciate that. Thank you so much for watching. Just kind of to finish up here, I want to give some disclosure. Essentially, I am not a financial advisor. I am just sharing my financial journey for fun and entertainment purposes only. The models and graphs are not guaranteed to be accurate, but I do my best. I plan to own some of the stocks mentioned shortly, specifically Lockheed Martin. And of course, there are risks associated with investing in the stock market, and please consult a financial advisor and do your own due diligence prior to investing. Thanks for watching, and I hope to see you next time.